If you're a central bank, you think, do I really want to lease my gold under these circumstances? It's now going out of the control of the Bank of England. The Bank of England told me before, it stays in the vault, don't worry, and at the end of the lease you get it back. That is now no longer happening, or there's a risk that it's not happening. I don't think I want to lease my gold anymore. I come to the conclusion that leasing is coming to an end, and that is withdrawing huge quantities of bullion, physical bullion, from the market, and the consequences will be seen in the paper markets because they will contract on the back of it.
This is Little by Little with Andy Schechtman.
All right, everyone, welcome back to another episode of Little by Little. I am thrilled to have with me someone I've been following for a very long time, Alasdair Macleod. Alasdair is the author of the Macleod Finance Substack. I strongly recommend people check it out. Information is fantastic and something that I find invaluable in my own research. Alasdair, it's great to see you again, buddy. How are you?
I'm very well, and thank you very much for having me on.
Couldn't be happier to have you here, and we'll jump right into it out of respect for your time. But a series of questions that I think should be fairly easy for you to answer. We'll start about talking about the banking system and the fragility of the highly leveraged banking system. You've spoken a lot about banks like Standard Chartered. I believe they're in France, if I'm not mistaken. You can correct me if so, but let's focus here in the United States. What are your thoughts on the current state of the banking sector? You know, we saw the first bank bail-in with the Bank of Lindsay, Oklahoma last October. And I've been waiting for another one, a bigger one, maybe to trigger something a little more systemic. But I'm curious, do you see a crisis brewing underneath the surface, or have they somehow been able to paper this over so that the problems may not be as big as some analysts have thought?
Well, there's an awful lot of papering over going on, I'm sure of that. And yes, it is a problem. But at the moment, I think the American banking system is giving a problem to what we in England call the SMEs, the small and medium-sized enterprises. They're not lending. They're not providing the liquidity that businesses need. And the reason for that is they see risk. I mean, you know, we've seen with the commercial real estate business, for example, you know, in various other areas. This is something that bankers just don't want to know now because they see risk. And, you know, business out in you know, outside the main conurbations is not good. So what they're doing basically is they're lending money to the government, and they're lending money to you know, by buying T-bills. I mean, they can't destroy credit once they've created. This is the problem. The only way credit gets destroyed is when people go bust and they default. So they're stuck with credit. So what they're trying to do is they're trying to move the credit from risk to what the regulators say is non-risk. In other words, you're looking at short-term finance for government. And that's basically what the banks are doing. Now, interest rates will rise, and I can explain why. I think that's a separate question. The consequences for that will be huge, great problems developing for the entire financial system. I mean, I can see the equity market bubble bursting completely. I think President Trump's tariffs, I call those Smoot-Hawley Mark II, basically. And if you think about it, 1929, we had a credit bubble which bust. That was the Roaring '20s. And we had Smoot-Hawley at the same time, which was legislated, or it was signed into law by Hoover in 1930. It was that combination, basically, that killed the global economy. And here we are going down the same route. This is important because the banks basically are the guys, if you like, who are taking the risk on this. And but at the end of the day, of course, we don't want our banks to go bust, and the central banks will do what they can to rescue them. But Andy, there's another problem, and that is that the central banks are all deeply in negative equity. People think that it doesn't matter because they can always print their way out of trouble. But yeah, if they do that, they collapse the currencies. You know, and there is another problem, and that is that, you know, if they don't print their way out of problems, then they have to turn around to their major shareholder, which in this case is governments, for finance. but the governments themselves are in a debt trap. So the governments, the whole situation actually is all it's all set to fall over. That's the trouble we face. And that's why it's so important to understand the difference between money and credit. Money being gold, credit being everything else.
Yeah, as JP Morgan once famously said. And so why do you see interest rates rising? Because all we hear about, and of course I agree with you, but all we hear, the conventional wisdom is whether it be from Trump or Scott Bessent, the drive to whether it be pushed down the federal funds rate, or as Scott said, actually somehow, not quite sure how he plans on doing this other than to monetize the debt, but to bring down the 10-year yield. How do you see that unfolding?
Well, basically, you've got to understand what an interest rate is. It's basically compensation for risk. Now, if you're a foreigner, look at it from the point of view of a foreigner, sort of, if you like, being offered the option to subscribe for US Treasury debt. He will start thinking, okay, if I'm going to buy this debt, what's going to be the purchasing power of the currency which I have to buy in order to buy this debt? Now, if the purchasing power of the currency is going to decline by, say, in my estimation, say 5 or 6%, then quite frankly, to get a 4.3% yield on the 10-year proposition, forget it. No, it's got to rise. And the other problem that we have, I mentioned a debt trap. When you get a situation where GDP is growing at a slower rate than government debt, basically the basis in which government debt is financed, or government finances are financed, is basically the revenue base, which is proportional to GDP. And if that's not growing as fast as the debt, then the debt is basically running away with the situation. It's called a debt trap. And that's really where the US government is. And it's not just the US government, it's most of the major G7s, with the exception so far of Germany. So, that's why interest rates rise. Let's look at it another way. Imagine that this is 1923 and you're in Germany. The economy is in such a mess. It's horrid. It really is horrid. So how does the government rescue things? Suppresses interest rates to zero? What? The interest rate is a reflection of the development, if you like, the evolution of the purchasing power of the currency. And if the currency is going down, and this is what gold is telling us, actually, we don't need me to tell anyone, gold is telling us the currencies are going down, then interest rates have got to go up. It's actually quite simple.
Yeah, it makes a lot of sense. It does, no question. So just to expand on that question, pull a few strings here. The United States is roughly $200 trillion in debt. We talk about the $36 trillion, but that doesn't take into account the off-balance sheet massive obligations of Medicare and Medicaid, Social Security, and all the pensions, government and military alike, and other entitlements. $1 trillion seconds ago was 31,688 years ago. These numbers are becoming massively. And now we find, to your point of tariffs, that we're relying on tariffs and sanctions or tariffs that masquerade as sanctions, I guess you could say as well. Not just tariffs that are trying to benefit the strategic manufacturing sectors, but tariffs that are more of a sanction. If you don't do this, then we'll do this. So that's not good. And at the same time, China and Russia are trading more in their own currencies. They are shedding treasuries. Yeah. As we've seen net since 2014, there hasn't been any new central bank buying of treasuries, or there has been, but the selling has been greater. And they're also buying gold, as we know about. Now, I remember a couple of years ago, and I've used and always given you credit for this. A couple of years ago, you talked about, it was your belief that China could hold up to 38,000 metric tons. I think you said 20 by the state and 18 by the people. And I am curious to know what you think they have now, but with the rise of the BRICS and the alternative trade systems that we're watching happen right in front of us, I guess what I'm getting at with all of these things put together, the debt, the de-dollarization, the accumulation of gold, the problems that we have in this economy, are we watching the decline of the dollar as the world's reserve currency in real time, or is that being overstated, as a lot of pundits would say?
I think, no, it's not being overstated at all, Andy. And I mean, quite frankly, the whole of the fiat currency system post Bretton Woods is now running out of time. The reason that China has accumulated gold and Russia is doing it so as well, quite simply, is because under Marxist theory, they reckon that capitalism is doomed and the currencies will be doomed with it. The only protection which they understand, and of course you and I understand, is to tie the value of their credit, yuan or rubles or whatever it might be, to gold. And if you tie it irrevocably to gold, then you protect yourself from the mess that we in the West have got ourselves into. And we've got a real problem because it's not just, you can't sort of just wave a magic wand and say, oh, well, just put the dollar back on the gold standard. The problem is that the US Treasury is invested in getting gold out of the monetary system entirely and has been describing as a pet rock or whatever. And not only that, but the entire intellectual economic establishment believes in sort of, if you like, macroeconomics, Keynesian and monetary. But particularly Keynesian, and they've got to be persuaded off that. I mean, the whole of the macroeconomic thing is basically a non-science, and so you've got to re-educate the entire establishment. And he goes into the investment establishment, the investment management establishment as well. I mean, how much gold have they got? I worked it out that on average they've probably got about 0.07% of their funds under management in physical gold. There's a bit more maybe in ETFs. I mean, the problem being, of course, is that in our wonderful regulated system, gold is not a regulated investment. And if you're going to hold it as an investment manager, you got compliance on your back saying, what the hell are you doing?
Isn't that funny? Compliance on gold, but not on over leveraged equities. It's a crazy world we live in.
In fact, not only over leveraged equities, but also sort of derivatives and things like that. Well, I mean, an ETF is a form of derivative, and that's a very, very good case in point. I mean, the management costs, if you like, of holding gold through an ETF, for a start, is considerably greater than storing it in a proper insured vault. Not only that, but you don't actually possess the gold. So the whole system basically is a mess, and the only protection from a collapse in the system. And believe you me, we are in the biggest credit bubble in history. And I would tell anyone, viewing this, if you wonder, why is this a credit bubble? Are you sure this is a credit bubble? Just look at the debt side. We can all agree that this is the largest amount of debt ever. And you came up with some numbers, 36 plus 200 for the US. This is the largest debt bubble. Now, the point is that credit is the other side of debt. So if it's the largest debt bubble, it's the largest credit bubble. And credit bubbles, when they burst, and when they're too big for the establishment, if you like, to just sort of midwife things through, like they did in what was laughingly called the Great Financial Crisis. The next one, I can tell you, will make that look like a tea party. This coming crisis, I think, is going to be so massive, and nobody has any gold. I mean, it's way. I mean, even including mines, it's less than 1% of the total of some 300 trillion of investment assets. I mean, so what we are going to see, I think, Andy, is we're going to see a huge rate portfolio shift, if you like, away from, sort of financials and away from tech stocks and all the rest of it, into mines and all the rest of it. And, the problem is, of course, there's been no money, as far as the brokers are concerned, in investing in mining research. So they haven't got the capacity, really, to deal with these portfolio shifts. It's going to be a very interesting time.
That is a Chinese curse. We live in interesting times. You mentioned a few things. You talked about the ETFs having a management fee greater than the cost of storage. That's true. It's 40 basis points on GLD and SLV. And I find it interesting that JP Morgan, who paid a $920 million fine for manipulating the market, has always been allowed to be the primary custodian, they and BlackRock, of SLV, and now has subsequently recently taken over almost entirely as the primary custodian of GLD. And in two vaults that they have, one in London, one in New York, they have more gold than the majority of the G20 countries. Interesting to say the least. But yes, in a vehicle where you can never take possession of the metal, only they can as the authorized participants. It just is, there are far better ways of owning gold than GLD and SLV. Yeah. So kind of, again, pulling on this same string, since November, the United States has become a net importer. Now, you had mentioned what the Treasury calls gold a pet rock and has been trying to push away from this, which I do agree with. But it's weird, Alasdair. Something's going on in gold that I've never seen. I've been doing this for 35 years. I've never seen the U.S. as a true net importer of gold and silver. I have never seen these kinds of deliveries into the COMEX where the February contract saw 6 million ounces delivered, where JP Morgan delivers 4 billion with a B in gold for a client in March into COMEX. We've seen significant inflows of not just gold, but also silver into COMEX, while the LBMA in your backyard seems to be increasingly coming under strain. They're a T+1 market, as you know, T being the trade day plus 1 to settle. The third day, you're supposed to have your metal moving on its way towards you. Now we're told, due to lack of trucks and manpower, which I find extraordinarily silly, the Bank of England is saying it's not enough trucks, manpower to move the metal. They're now T plus 8 weeks. When you hear this, what immediately goes through your head?
Well, I am sort of aware. I mean, I've observed the movements in the past going into the back entrance of the Bank of England. In fact, I used to lunch with the head of the foreign exchange department occasionally in the Bank of England. And we used to see these trucks going in. I mean, I think it was really 2 days a week. You get about 5 or 6 trucks going in and out and all the rest of it. And you'd never know what they were actually carrying. But there is a logistical problem. The other thing I would say, Andy, is that I don't really regard the Bank of England vault as a major storage point for commercial entities. It's basically for central banks. So if commercial entities are taking gold out of the vaults, then I'm fairly certain that this is going to be leased gold. Now, this is important because I think if you look at the leasing operation, leasing, swap, whatever, if you look at that, I mean, Frank Venerosa wrote about this back in the late 90s, and also he spoke particularly at, I think it was 2002 in Lima, where he concluded that possibly between 10 and 16,000 tons, and that's between a third and a half of all central bank gold, was out on lease at that time. And as he put it, was adorning the necks of Asian women. In other words, it had gone into the market and wasn't going to come back. So there is this problem, I think. Now, I think that following that, basically the way the Bank of England worked it was book entry transfer. In other words, we can arrange for gold to be leased to you as a commercial entity. But it remains in the Bank of England vault because it's got to remain in a vault somewhere. If you're using it, let's say for collateral or whatever it might be, then there's no need for it to move out of the vault. So this becomes what they call a book entry transfer. So in other words, you instead of having the stuff delivered into the market and disappearing, you had 2 owners, if you like, of the gold in the Bank of England's vault. So it didn't appear that there was a problem. I think the importance of this development recently is that this gold is now being arbitraged out of the Bank of England vault and into COMEX. The other side of the COMEX problem, I think, is the stands for deliveries. Now, I don't know who the hell's standing for delivery, but I'm pretty sure it's not swaps, it's not bullion bank trading desks or whatever. I mean, because apart from anything else, you had the situation which has forced a huge great premium on the futures, which has created this arbitrage in the first place. If it was just a matter of the establishment swapping chairs on the Titanic, you wouldn't get the premiums on COMEX. The reason that this stand for delivery, I think, is so important, and nobody seems to be mentioning it, is that if you work out the stands of delivery over the last 4 years, up until the end of last year, it was around about 2,000 tons, 2,100 tons, something like that. That is a huge amount of gold. But since the 1st of January, those stands for deliveries have accelerated at a rate whereby if that's maintained, it would be something like 1,700 to 2,000 tons this year alone. In other words, the pace of stands for deliveries has accelerated very, very sharply. Now, undoubtedly, this might have something to do with, Trump. Basically, you stand for delivery if you want gold and you don't want dollars. Really what you're doing is you're selling dollars and you're buying gold. But as we know, if you stand for delivery, you don't necessarily get delivery. That is something that sort of you have to keep on badgering to actually get. Now, put yourself in the shoes of, if you like, the establishment, if you like, which is faced with all these liabilities discharged. Because legally they should deliver a stand for delivery, so they can't ignore it. And they have the problem that if we get tariffs, then my goodness, we don't have enough gold to match this. So they had to create this enormous flood of gold into COMEX warehouses in order to cover those stands for deliveries. And I think that's basically what's happened. But the interesting thing, Andy, is look at the phases. First of all, the one that Veneroso identified, and that is that gold, if you like, was being leased out and then sold into the market and the proceeds used for a carry trade into US Treasuries. That was the situation up until the end of the last millennium. Then you have the big bit where it's sort of hidden because it works on a book entry transfer system. Now we have this situation where we've gone back to this stuff disappearing into the market. This is interesting. Now, if you're a central bank, you think, do I really want to lease my gold under these circumstances? It's now going out of the control of the Bank of England. The Bank of England told me before, it stays in the vault, don't worry, and at the end of the lease you get it back. That is now no longer happening, or there's a risk that it's not happening. I don't think I want to lease my gold anymore. So this is going to withdraw a huge quantity of gold from the market, which I think the market participants have been relying on, if you like, as a supply to this enormous demand, particularly from Asia, which basically is cleaning everybody out. So, if you look at the phases of this leasing thing, I think I come to the conclusion that leasing is coming to an end, and that is withdrawing huge quantities of bullion, physical bullion, from the market, and the consequences will be seen in the paper markets, because they will contract on the back of it. I mean, I think these are momentous times. I really do.
Does that mean too that the paper price or the real price will be more driven by the supply-demand fundamentals rather than the ability of the banks to leverage? Because before you answer, when I look at the LBMA numbers, I see that they tell us they have just under 280 million ounces on paper, of which only 36 million are actually available. Call that the float. So the rest, 240-ish million, belong to the Bank of England and to ETFs. Okay. But yet there's 380 million ounces in outstanding spot contracts with only 36 million available for delivery. When you see this metal coming, now you say it's arbitrage. Okay. The same breath you say it's also flooding into the COMEX to cover these positions, these delivery demands. What does that do in the end, doesn't that potentially set up a really very dangerous situation for the Bank of England and for the LBMA ultimately?
Well, yes, it does, and not just for the Bank of England and the LBMA. I mean, basically, it's cleaned out liquidity from virtually everywhere, as far as I can see. So yeah, I mean, it's cleaned out the liquidity, and the point I'm also making is that on top of that, you're going to see central banks saying, no, we don't want to lease our gold anymore, and I think the effect on the price actually could be really quite dramatic. And
how much of that gold is still out there that needs to be paid back? Give us back our gold that we leased you. Is that still something that's happening right now? Could that be what a good portion of this gold is? Could it be the gold that we've leased out that we are now reshoring? Could that be a possibility as well?
Well, yeah. I mean, you've got the unanswered questions of where did all the gold go out into the market? And this is not recorded because under IMF accounting, if you lease gold, you can still account that you own it, but you don't. You don't own it if you've leased it. When it comes back under the terms of the lease, then you own it again. But I mean, this is the point about Venerosa's work, which was very, very thorough, actually. And he was talking to Terry Smeaton, the guy I used to have lunch with occasionally. I mean, I'm going back into the 80s now. Smeaton was a very bright guy. I mean, he knew his onions, certainly. And as head of the foreign exchange department in the Bank of England, he was responsible for gold dealing as well. That gold is out. Effectively, it's gone. And I think when we saw the Bundesbank trying to reclaim only 300 tons, now, I'm sure that the Bundesbank wanted more than that, and they were told, no way. So what happened? Where's it gone? It's been leased. It's gone. It's gone. It's not that. And so this is why it took, the New York Fed had to turn around and say, well, we will deliver it to you, but we're going to need 7 years. That was just amazing. 300 tons. They're going to say it'll take us 7 years to get it back to you. In the event, they got it back a lot more quickly. But I think I'm right in saying that the bar numbers that the Bundesbank got didn't correlate with their original list. So, it wasn't that original.
Yeah, that's a problem. I heard that too. And to me, it's no coincidence that shortly after that happened, the Dutch National Bank, the Bank of Hungary, Turkey, Poland, the Czech National Bank, Bank of Austria, they all did something similar. Give us back our gold, please. That's been a trend that we've seen continue to this day. I remember reading Frank, I've been doing this since 1989, before the internet. Like you, I'm one of the old timers. And I always like to, when I can, give a plug to GATA, Bill Murphy, Chris Powell. That's where I learned of Frank. And we all of us gold bugs, people who understand hard money, owe the hard work, tireless work of Bill and Chris a debt of gratitude. So Bill, Chris, if you're listening, I love you guys. And I think, right on. I'm glad you say that. And it's been an uphill battle for those guys. I hope they get to see the fruits of their labor come to fruition before too long. Anyways, I appreciate your perspective on things. They're brilliant, and it's nice to hear the opinion from someone who lives in the UK as to what's going on with the LBMA. Certainly interesting times indeed, as the Chinese curse says. So let's just pivot just a little bit. I interviewed Judy Shelton not too long ago, and by now most people know who she is. She was Trump's nominee to run the Federal Reserve in 2016 due to partisan politics. Shockingly, wasn't confirmed. Some think that she might actually take over that role when Powell leaves in about a year. She told me, Alasdair, she told me flat out that she believes that Trump will issue gold-backed treasuries. And she even mentioned a date to me. July 4th, 2026 is when she thinks he will issue them. This is what she said on my interview, flat out. He's going to issue them on July 4th, 2026, which is the 250th anniversary of the United States. Do you think that approach could work? The more I think about it, I question Because why wouldn't central banks just prefer to simply keep buying physical gold instead, rather than a U.S. Treasury redeemable in gold? The only thing that I can think of is maybe it would be slightly more liquid, bang, bang, boom, without having to move custody. But what's your thought on what Judy has to say?
Well, my thought on it is, do you really trust the U.S. government if you're going to issue, a long bond convertible?
50 years is what she originally advocated for. In the book, sorry to interrupt, in the book, she does talk about shorter duration, but to your point, who the hell wants to hold a 50-year treasury? We promised to pay in 50 years. Okay, I'll just go buy gold myself is kind of my thought, but please continue.
Well, absolutely. I mean, that's I think. I mean, let's put it, if you like, sort of slightly less dramatically. I think there is a trust problem that needs to be surmounted for that to work. And I think it's at two levels. I think, first of all, you have to trust what a Trump presidency, comes up with in that sense. And secondly, you have to trust that the gold is in deliverable form. And there have been enough stories around about the gold in Fort Knox, because we're now talking US Treasury reserves. We're not talking about earmarked gold for foreign central banks, which is the New York Fed stuff. I just sort of think that there are a few hurdles which have got to go through before that can possibly work. And I mean, quite frankly, if you're going to go down that route, then I suppose you revalue the gold. I don't know. How do you revalue it? It sort of raises just too many questions. And I think the approach of the bureaucracy in the Treasury is, look, just don't stir it. Just keep quiet. Don't bring this subject up. This is just too much bloody trouble. Just stay off it. So I think, I think from every point of view, I mean, I'll see it when, I'll believe it when I see it, really.
I don't know if you noticed me grinning. I'm like, are you looking at my notes somehow? Because that's what I wanted to talk to you about next. I said to Judy, do you know that the gold held on all the Western central bank balance sheets is held in what's called the gold revaluation account? That's the name of it. Whether it be in London or the United States or Switzerland or Austria or any of the Western central banks, they're all considered, or the name of the account is called, rather, the gold revaluation account. Now, we've had members of the Bundesbank advocate for revaluing the gold, which is valued at $35 an ounce in Europe. We've also had the head of the Dutch National Bank be very vocal about this. We had Senator Loomis from Wyoming talk about revaluing gold to fund the Bitcoin strategic account. All of these calls for revaluing gold are, these are things I never thought I would hear in my lifetime. Now, let's remember that over my shoulder, Roosevelt revalued gold in 1933 when he confiscated it at $20 an ounce, paid everyone $20.67. And, with a dozen eggs being a nickel, 67 cents was a lot of money back then. Then he subsequently devalued the dollar by 40%, revaluing gold by 40%. And when Nixon closed the gold window in 71 at 35 an ounce, this next year he revalued gold by 8%, or devalued the dollar to 38. And then the next year from 38 to 42.22, where it's sat on a U.S. balance sheet ever since in the gold revaluation account. And I asked Judy about that and asked her, did she think it would be revalued? Now, she wasn't as straightforward as she was everything else, but if I had to kind of sum up her answer, it was kind of like, well, yeah, maybe. So do you see a gold revaluation as a possibility? Now, before you answer that question, first of all, certainly it would benefit all the central banks who have been buying it. And in looking at, like James Rickard, who's no dummy, he's talking about it as well. And the number he uses, I think, if I'm not mistaken, was around $12,000. And he got there by taking 40% of the money supply, taking the gold that hasn't been audited, assuming it's all there, and dividing it into that number, and he gets $12,000. And I'll explain the significance of that in a moment. But if you remember, the United States passed a law in the mid-50s switching from 100% gold backing to 40%. The Swiss used a 40% gold backing. And Dilma Rousseff, the former president of Brazil and the head of the BRICS New Development Bank, has recently been quoted as saying, in theory, the BRICS have agreed to a settlement currency or settlement token called the unit. Now, that's been delayed a little bit due to various issues with the BIS and Enbridge. We don't need to go into that. But the bottom line is we keep seeing this 40% number, whether it be the United States, Switzerland, and now the BRICS. James Rickards used that 40% backing. Now, a $12,000 price of gold, if they said it's $12,000 and they wouldn't really need to do too much, and they just issue new treasuries or gold certificates to the Fed, who would print the money and give it to the Treasury. And just as a point of clarity, they do not then have a claim on that gold as many people think. They don't. It's an accounting gimmick. They have claim on the printed money, in essence, on fiat, not on the gold that they would represent. But anyways, the point is, according to Jim, every $4,000 increase in the price of gold would give the Treasury General account $1 trillion free and clear. At $12,000 announced gold, you now give the Treasury account $3 trillion free and clear to do with as they wish. So with all of that being said, and you're a smart guy who's been at this longer than most, do you see this as a possibility? Maybe on the heels of some sort of a broader monetary reset, or do you see the challenges just being too much to overcome?
Well, the 40% rule actually was set by Sir Isaac Newton when he was Master of the Mint in 1700 and something or other. So that's where that came from. Everybody has been quoting, if you like, that's the minimum that you need. And the Bank of England, sort of worked on that to begin with before the Napoleonic Wars and all the rest of it. So that's where that came from. I actually take a different view. It is perfectly possible to manage a gold reserve so that it is credible, which is the important thing, because it's got to be credible and back the credit, because it's credit. We don't go out and spend gold. No, it's always credit. But the credit has got to be a gold substitute, which is what Mises called it. It's perfectly possible to have a ratio other than 40%, less than 40%. But in order for this to work, what you have to do is you have to use interest rates to manage your gold reserve. In other words, when your gold reserve goes down, for whatever reason, you have to raise rates in order to encourage the flow of gold from other centers which have lower rates. That is the way in which it works. And so the whole of the Fed's approach to use interest rates to try and manage economic outcomes is completely wrong. It is there to manage the gold reserve. No, we don't have a gold reserve anymore, but you can see it still works sort of thing, between different currencies. So, you can have a crap currency like sterling, with a government which, quite frankly, is lacking in terms of credibility. And sterling holds up. Why? Sterling holds up if there's a higher interest rate. In other words, interest rate manages the, if you like, exchange rates. It manages the gold exchange rate. That's the way in which you do it. So you don't need to get stuck on this 40%. But what you have to do is to run things in such a way that the issuer has control over interest rates, not the banking department, which is the way in which they tend to think today. So I would dismiss this idea of, $12,000, whatever. That, I think, is actually the wrong way to look at it. My way of looking at it is really very, very simple. You could actually fix the dollar at the current exchange rate, in theory. But of course, so many things have got to change in terms of the way people think, the way in which interest rates, how are interest rates, why are interest rates changed, and all the rest of it. All that's got to change. Macroeconomics has just got to go out of the window completely. Then you could actually quite easily run the dollar at $3,000 to the ounce. I mean, that wouldn't actually be a problem if you took that route. But it has to be quite clear. You've got to manage things in such a way that you maintain an adequate gold cover and you make it exchangeable. Credit has got to be exchangeable. This is, the idea that you can sort of just say something and everybody will believe it. I mean, I'm sorry, that really doesn't work. It might work for a brief period of time, but no, it's got to be fully exchangeable. So we're going back to pre-1933 arrangements. The important difference being that the Fed would have to divide itself into two departments. You've got the issuing department and you've got the banking department. Where the Bank of England went wrong with the Bank Charter Act of 1844 was it gave the management of the interest rates to the banking department. No, that should be entirely the preserve of the issue department, not the banking department. So it's actually, I think it's quite simple. And I think if you look at it that way, then, there isn't really a problem of putting things onto a proper gold reserve. You just got to do it properly. But I mean, central banks at the moment, they just can't think like that. The way in which they look at gold is, we've got our gold. They're holding on to it. They're behaving like us, if you like, frightened of credit, and they won't let us have any gold. So it's sort of, it's my gold. Central bankers saying it's my gold, it's my gold. They won't let us have it, which is complete nonsense. It's it's a misunderstanding of really what the role of gold is, which quite simply is to, if you like, fix the value of credit. And that way, I mean, this was what happened when we had, we had a proper gold standard that ran from after the Napoleonic Wars all the way up to the start of the First World War, the Great War, the Kaiser's War, as my grandmother used to call it. If you looked at what happened to prices, I mean, particularly as the banking system became better and better, you had things like, clearing facilities and all the rest of it, and they evolved. I mean, the prices really in around about 1820, 1830 were exactly the same as they were. I'm talking wholesale prices, a manufactured, admittedly, wholesale price index, exactly the same as they were in 1900. I mean, 80 years of steady prices. That surely is the best thing, because it means that businesses can do their economic calculations. It means that savers are encouraged to save. And for God's sake, keep the central banks out of it. I mean, they've just got one function, and that is to secure the value of credit against gold. It's actually
a world with no inflation would be nice. I asked Judy that. I said, "Who the hell came up with this idea of striving for 2% inflation?" She said, "Yeah, it was Janet Yellen's husband, another economist. I didn't know that." And she says to me, I couldn't believe she admitted this. She said, the thought process was that, well, if you have stable prices, you really can't give your employees raises, and they don't like that. But if if you have a 2% inflation rate, you can give a 1% raise annually to your employees, and they'll feel like they're getting ahead. Actually, they're going behind. I mean, she actually admitted this, and I don't know, I thought it to be kind of icky, to say the least. But yeah, I'd prefer a world of a whole generation of stable prices. That would be something nice, especially living in a world where it seems that the cost of living is getting more and more and more expensive. My dad said to me, Andy, I graduated college in 1963. I married your mother that year. And my first job out of college, he says, was making $5,900 a year, and we could live very comfortably for a year on $5,900. I can't even wrap my head around that, Alasdair. I can't. But I guess that's what happens when your currency every single year is eroded insidiously by the hidden factors of inflation. So that's interesting when you phrase it that way, that for 80 years you had stable prices.
Yeah.
It's very interesting, to say the least. Well, let's hope they figure something out anyway. And the only thing that I think of when you say that has to be redeemable is, President de Gaulle proved that redeemable currencies redeem or convert. Let's just hope they figure all of this out. I guess only time will tell. Certainly the tier 1 revision of gold gives me hope that maybe they are thinking this way. Anyways, I've taken a lot of your time. I'm going to ask you 2 more quick questions. The first one I've heard you talk a lot about, it's the gold to silver ratio, and it's hovered at historically high levels for quite some time now. much longer than I ever would have anticipated. What's the old saying? The market can stay irrational longer than you can stay solvent. A lot of people have noticed the gold-silver ratio, have switched their gold to silver, and are waiting angrily as the price of gold has taken off and silver really has somewhat languished in respect to gold. To me, this screams of silver's massive undervaluation, independent of the gold-silver ratio. What are your thoughts on silver?
Yeah, I'd agree with you. And, I'm personally in the same sort of camp, as it were. I got some silver. And why have I got some silver? Because I think that at some stage, is going to rocket up relative to gold. In other words, the gold-silver ratio falls, and then I will switch. I mean, to put it in a monetary context, silver really lost its value as money. I mean, it was always, if something is valued as money, that is the highest level of valuation that it can get. And it lost that in about 1870. In the 1870s, basically, it was after the Franco-Prussian War, when Germany managed to get recompense out of France in the form of gold. And so Germany was able to go onto a gold standard, and basically the rest of the continent followed. So that was, from that point, the silver price dived. Until then, you had an exchange ratio of sort of 15 and a half, whatever. And now we're 90. Now, I think that's crazy, if you like, looking at that number. Basically, there is a monetary role for silver. And when we get back to the situation where a wider public realizes that it's not gold going up, but it's fiat currencies going down, then I think you'll find that there will be demand for silver on the basis of its monetary qualities. Now, it's never going to be as much money as gold, because central banks, for a start, don't accumulate it. And secondly, bimetallism is always a problem. So you're not going to have sort of some gold, some silver standards and all the rest of it. There's always going to be a gold standard. But when we had a gold standard, silver was legal tender up to 40 shillings, which is £2, 2 sovereigns, if you like. So I think that silver will have that minor role, if you like, and we will edge towards it as a greater a proportion of the public begin to understand that it's their currencies going down and not gold going up. So I think that's important. When it comes to its use as an industrial metal, which is its pricing at the moment, I think that it is very undervalued. It is the best conductor in the world. I mean, there's so many points about silver. It kills bugs. It does everything. I mean, it's just the extraordinary metal, and it's better than lithium, I think, in so many applications. The electronic applications, just absolutely amazing. I think that the price has been sat on, particularly by China. That's my view. And I formed this view because many years ago I spoke at a conference in New York, and there were quite a few silver producers exhibiting there. And I went around all of them, and I asked them the same question. I said, how do you turn your silver doré into cash, to pay your miners and your energy costs and all the rest of it? And the answer was that the man from Glencore would come round and he would value it. On the basis of that value, they were given a check. And now I worked out that the check would actually come from JP Morgan. You're talking about very big boys here. You've got Glencore, JP Morgan, if you like, doing the money side of it. And so, and I asked, well, where is it shipped off to? Well, that wasn't our problem. We don't know, but we guessed China. Yeah, China. And China was also something like the 5th largest producer of silver in the world. So it wasn't it wasn't as if it had a shortage of silver. And I think that while China stockpiled gold in the big bear market from 1980s all the way to 2002, when they then opened the Shanghai Gold Exchange, I think they were also stockpiling silver after that, particularly after that. And they were doing this, I think, by suppressing the price, in effect, hedging everything so that they could drive the price down, if you like, on the futures markets and control the physical price as well. Because, I mean, the great thing about, the way these large deals are done is they bypass the market. They just use the market as a reference. So if you've got a thin market, you can suppress the market price. And then you get your X 10,000 tons of silver, you get it nice and cheaply. That's the way it works. So suppress the price in the market, and then you can, you get it for virtually nothing. And I think that's been going on for so long. And one of the problems, I think, is that the people who sort of maybe have sort of invested in silver, they're a bit more flaky, let's say, than the gold bugs, and that doesn't really help. So, it's a number of things, but I have no doubt that once it clears this 35 level and probably 34, I think it's probably going to go off to the races. That's my view. I'm not making a recommendation, but that would be my view.
Yeah, you mentioned they're more flaky. They are. I mean, a lot of them are where the gold bugs are more concerned about preservation. You find a more aggressive stance with silver. It's the profit potential. Yeah. It's a silver squeeze. You're right. And I think that isn't the right. I think you don't buy gold and silver to become wealthy. You buy it because they are wealth. And if you own enough of it, you will be wealthy by default. But I do agree with that. And another interesting point I've talked a lot about lately. So China has progressed to the number 2 largest producer in the world. And I've done interviews with some of the mining executives like Sean Kunku and Udali Varden, who said, Andy, their Chinese are flying all around Latin America, in particular Peru, who's the number 3 largest producer in the world, and buying up all of their doré and concentrate, which is like a sludge, paying double what the West will pay, sending it, which disintermediates the marketplace, and then sends it directly back to China for refining. And it's interesting that the number 2 producer in the world, who you're saying is sitting on the price of silver, would take the time to fly to Latin America, buy the doré and the concentrate, and ship it back from the number 3 producer. In other words, silver, I believe, is far more important than the price would lead on. And when you add that to what you say, it even becomes more interesting, certainly, for sure. So yeah, I do look at silver as one of the best opportunities on the planet at this point.
That's very interesting, Andy, because it's the same story that I discovered sort of 12 years ago. I mean, this is when everybody thought that it was JP Morgan who was hitting the price and suppressing it off their own book, and Blythe Masters actually went on television. I think it was CNBC or something. Specifically,
we don't hold it for ourselves.
Yeah.
Right.
Now, that lady is a cute lady, and she would understand that you do not lie. On a television interview, you do not lie on something like that. So it was quite clear that they were working for a customer, and the customer, of course, would be the Chinese government.
Well, and that's why I also found it interesting that that JP Morgan delivered $4 billion in gold to the COMEX in March. So who's that customer? To her point as well. And in fact, I've mentioned her name quite a bit in that context. I like that we are on parallel thought patterns here. Last question for you, my man, and you're fantastic. I really do appreciate you spending some time with me, Alasdair. If you're like me, which after this conversation, I think, in some respects, we see the world similarly, probably more so than I'm even giving it credit for. It gets to be a drag sometimes, always being the buzzkill, being the guy that, you don't want to talk about this stuff at the cocktail party, or, Mr. and Mrs. Macleod may not be invited back to the party. I feel that way all the time myself. It's not the hope springs eternal. It's you better protect yourself, because these are sobering thoughts, realistic thoughts though, but sobering. And a lot of people just choose not to listen to that information because of the message that comes with it. So let's end on a high note and say, look, you've painted a very good and clear picture of the challenges ahead, whether it be with the banks or the economy or the currency or interest rates or all of these things that are sobering. But certainly I'd rather know what's coming so I can get out of the way of it. You can't get out of the way of what you never see coming. So God bless you for having the courage to say these things. And I often think about doing the same thing myself and feel I'm doing my part as much as I can, as honestly as I can. So thank you for that. But let's talk about what gives you the most optimism right now. Is there anything happening in the world, the economy, philosophically or otherwise, that makes you feel hopeful for the future? I'd love to hear your thoughts on that as we say goodbye.
Oh, Joko, that's a tough one.
Yeah. Well, there you go. That's tough being in our position, trying to find optimism in a scary world, but there's got to be some somewhere.
Yeah, I think the answer to that is humanity, really. I think we're getting away from and thanks to President Trump in particular for this one, we're getting away from this wokeism stuff. And I think that's desperately important because, we are social. We are a society. I mean, we need to coexist. And the idea that we have no morality, we have no, which we got from Christianity, let's face it. And we've sort of done away with that. And we've now got this sort of ridiculous set of, you can't call someone this, that, or other thing. And, it's gone into business and you find that people get sacked or they get suspended because they said something which is just, which you and I would probably say was bad manners. Bad manners. Okay, that's it. End of story. Now, we've got to get away from that. And I think that Trump is moving us away from that. The other thing that Trump is doing, which I really do applaud him for, is he is giving the lie to this climate change rubbish. Because this is something, certainly in Europe, which is, if you like, being embraced by the far left, who really want to find an alternative way of destroying capitalism. And they want to do it through the democratic process. And President Trump is blowing a huge, great hole in that. And good for him. I mean, there are other aspects of Trump I would, if you like, hesitate to support. But on those two things, I think that's good. So that, to my mind, we can actually have a better world as a result of the changes that are going on now.
Well, I love that you've said that, Alasdair. And I've been very vocal, I mean, I'm a gold guy doing podcasts and screaming about that for the last few years, to the point of I get off sometimes and, geez, I wonder if I should have said that. But I come from nowhere, nothing. And meritocracy is what gave me the ability to outwork the competition, whether it be in athletics, which I had great success with, or here in business, which I've had great success. No one gave me anything, or my family. We come from nothing. And in fact, my father's middle name is Miles, and his friend who lent us $60,000 to start a company in a tiny box-sized office the size of a closet 35 years ago, his middle name was Franklin, on a wing and a prayer. And it's through hard work. It's through, the opportunities that were afforded to me. God bless this country for giving me those opportunities. That was the one thing that upset me more than anything over the last 4 years. All economics out the window and everything. It was the departure from our culture. And I agree with you completely and wholeheartedly. Love to hear you say that. Success should be about how hard you work, not your lifestyle. And certainly being a child of a pair of hippie parents in the 70s, I know all about lifestyle, and yet, it's choices that you make and the effort that you put into it. So I appreciate you saying that, Alasdair. You are a treasure. How can people find out more about what you're doing? Your Substack, of course, on X. What's the best way for people to follow you? Of course, we'll post links to all of that below, but what is the best way for people to follow what you are doing? And I think they should.
Yeah, it's. You can become a free subscriber to my Substack, which is alasdairmacleod.substack.com, or Google Macleod Finance, and I'm sure you'll come across it. And what I do is interviews like this I post free. But I would suggest that it's worth becoming a paid subscriber because a lot of my written work I reserve for my paid subscribers. And I think if you're going to get the understanding that you really need in order to protect your wealth through these increasingly difficult times, then you've got to understand a bit of the theory behind it. You've got to understand the difference between money and credit. And you have to understand, the problems in the system, if you like, the banking system. You've got to understand the way government accounts actually mislead you and the way in which government statistics mislead you. All those things are so important to protecting yourself through these very, very difficult times. So that I would strongly suggest you should consider.
I would too. I am a paid subscriber. You're a prolific writer and a damn good one, and I hope people check it out. You're one of the few that I do pay for, and well worth it. Alasdair, I do hope our paths cross sometime in the near future. If you're ever down the southern Florida way, I hope you'll reach out to me. I have dinner with your name on it. Love to sit down over a bottle of wine, or being that it looks like you're in the Scottish, looks like you're sitting on the Scottish golf course, if you ask me. I played out there, and that's what it looks like out of your window every day. A bottle of scotch and some long conversations about life would be great.
I'm actually in Cornwall. That's the sea. I don't know.
Do you ever get the sunshine out there? Is that what it's like almost every day?
Well, actually, the irony is I came down here, which is why I was a little bit, I came down from Devon where I live, and looking at my, my door cam, it's a lovely sunny day there. And here I got the mist. And it's cold.
It's still a pretty nice. Beautiful. It's a beautiful view. With clouds or no clouds.
Yeah, it's lovely. It's great. No complaints.
You are awesome, brother, and I really appreciate you coming on. I truly do, and keep doing what you're doing. We need you. You're one of the good guys. I wish you continued success. I do look forward to picking up where we left off. A lot of new, exciting things are going to be revealed about Miles Franklin in the next couple of weeks, and you'll be one of the first ones that we invite back on as a result of it. You'll see what I mean by that. But in any case, I wish you very well, and I look forward to chatting with you again real soon.
Well, Andy, thank you very much indeed for having me on. It's been very much my pleasure.
Pleasure is mine. You stay well.
And you.
Little by Little with Andy Schechtman.